Running a small business means I wear lots of hats. When I put on my hiring hat, I can count on LinkedIn Hiring Pro to make it easy. LinkedIn Hiring Pro helps manage my hiring workflow, puts my job post in front of a unique network of professionals, and matches me with the best candidates for my business. I can also share my job with my network. No other job site lets me do that. No wonder most small businesses say they'd use LinkedIn Hiring Pro again. Hire right the first time. Post your job for free on LinkedIn today at linkedin.com/quality.
Morning decisions. How about a creamy mocha frappuccino drink? Or sweet vanilla? Smooth caramel maybe? Or a white chocolate mocha? Whichever you choose, delicious coffee awaits. Find Starbucks Frappuccino drinks wherever you buy your groceries.
Welcome to Learn Finance 101, where we break down the key historical events within finance and economics. In this episode, we turn to the most recent major market shock in our series, the COVID-19 crash of February and March 2020, a global event unlike any before it, where a non-financial crisis, a deadly virus, brought the world economy to its knees in weeks. This is the story of how an emerging infectious disease, first detected in Wuhan, China, in December 2019, escalated into a pandemic that caused the fastest stock market crash in history. The S&P 500 fell 34% in just 33 days from its February 19th, 2020 peak, a bear market faster than 1929 or 1987. Trading volumes surged to records. Volatility indexes like the VIX spiked to 85. Global markets lost trillions in value. Governments imposed lockdowns that shuttered businesses, schools, and borders. Supply chains snapped. Unemployment claims soared to 40 million in the US alone. The crash was not caused by overvaluation or financial fraud, but by an external shock. A virus that forced the world to stop moving. The response was unprecedented. Central banks slashed rates to zero and launched massive quantitative easing. Governments unleashed trillions in fiscal stimulus, from direct checks to payroll support. The market rebounded quickly. The S&P 500 hit new highs by August 2020, but the economic scars lingered. Inflation surges, supply disruptions, and a re-evaluation of global resilience. The COVID crash tested markets in ways no previous event had, highlighting vulnerabilities in interconnected systems and the power of policy to mitigate disaster. In this episode, we will walk step by step through the origins of the pandemic, the pre-COVID bull market that left markets vulnerable, the escalating global spread in early 2020, the manic market reactions in February and March, the depths of the crash, the massive policy responses, the surprisingly swift recovery, the long-term economic and social impacts, and the enduring lessons that still guide us in February 2026 as new threats like climate shocks and geopolitical tensions loom. Let's begin by stepping back into the pre-pandemic world of 2019, when markets were riding high and few saw the storm coming. The decade before COVID was the longest bull market in US history. After the global financial crisis bottom in March 2009, the S&P 500 climbed nearly fourfold by early 2020, driven by low interest rates, corporate buybacks, tech dominance, and economic expansion. The Federal Reserve had kept rates near zero for years after 2008, then gradually hiked them from 2015 to 2018 before cutting again in 2019 amid trade tensions and slowing growth. Global central banks followed suit. European Central Bank and Bank of Japan maintained negative rates. Quantitative easing pumped trillions into assets. Markets were buoyant. The US unemployment rate fell to 3.5% in December 2019, a 50-year low. Corporate profits were strong. Tech giants like Apple, Amazon, Microsoft, Alphabet, and Facebook, now Meta, dominated, with the FANG stocks accounting for a massive share of market gains. Valuations stretched. The S&P 500's price-to-earnings ratio approached 25. Volatility was low. The VIX Fear Index hovered around 12 to 15. Investors believed central banks had mastered the business cycle. The Greenspan/Bernanke/Powell put would always support markets. But vulnerabilities lurked. Leverage was high in corporate debt and margin accounts. Global supply chains were tightly integrated, especially with China. The economy was late cycle. Expansion had lasted 128 months by early 2020. Few anticipated a health shock, but when it came, it hit like a sledgehammer. The virus, later named SARS-CoV-2, emerged in Wuhan, China, in December 2019. Initial reports described pneumonia cases linked to a seafood market. On December 30th, Dr. Li Wenliang warned colleagues online, only to be reprimanded by authorities. The World Health Organization was notified on December 31st. China locked down Wuhan on January 23rd, 2020, as cases spread. The first US case was confirmed on January 20th. Markets initially shrugged. The S&P 500 hit a record high on February 19th, 2020, 3,386. Investors saw it as a China problem, similar to SARS in 2003 or H1N1 in 2009. But as the virus spread to Italy, Iran, and South Korea in late February, fear set in. On February 24th, the Dow fell 1,031 points, 3.56%, as Italy locked down northern regions. The VIX jumped to 27. By February 27th, the Dow had fallen over 10% from peak, the fastest correction ever. March brought panic. Cases exploded in Europe and the US. On March 11th, the WHO declared a pandemic. President Trump banned travel from Europe. The NBA suspended its season. Markets plummeted. On March 9th, the Dow fell 2,013 points, 7.79%. Its largest single-day point drop ever. Oil prices crashed as Saudi Arabia and Russia started a price war. On March 12th, the Dow fell 2,352 points, 9.99%. Circuit breakers halted trading multiple times. On March 16th, another 2,997 point drop, 12.93%, the worst percentage drop since 1987. The S&P 500 bottomed on March 23rd at 2,237, a 34% decline from February 19th in just 33 days, the fastest bear market in history. Global markets followed. FTSE 100 fell 35%, Nikkei 30%, emerging markets like Brazil and India 40 to 50%. Volatility was extreme. The VIX hit 85 on March 18th, its all-time high. Daily life transformed overnight. Lockdowns closed schools, offices, restaurants, shops. Supply chains broke. Empty shelves for toilet paper, masks, hand sanitizer. Unemployment claims surged to 3 million in 1 week, March 21st, then 6.6 million the next. Businesses furloughed workers, airlines grounded fleets, hospitals overflowed. Central banks and governments responded with unprecedented speed and scale. The Federal Reserve cut rates to zero on March 15th and launched unlimited quantitative easing, buying treasuries, mortgage-backed securities, corporate bonds, even ETFs. The CARES Act, March 27th, provided $2 trillion in stimulus. Direct checks, up to $1,200 per adult, enhanced unemployment benefits, $600 weekly, Paycheck Protection Program loans for businesses. European Central Bank expanded QE. Bank of England cut rates. China injected liquidity. The market rebounded surprisingly fast. The S&P 500 hit new highs by August 18, 2020, fueled by stimulus, low rates, and tech stocks, FAANG plus Tesla. But the economy lagged. GDP fell 31% annualized in Q2 2020. Full recovery took years. Global deaths exceeded 6 million. Long COVID affected millions more. Inequality widened. Stock owners thrived while low-wage workers suffered. Why was the crash so fast and sharp? An external shock, virus, amplified by high valuations, leverage, and interconnected markets. Algorithmic trading accelerated selling. Policy response was key to containment. Unlike 1929, central banks acted decisively. In 2026, COVID's lessons endure. Non-financial shocks can devastate markets, global interdependence creates vulnerability, stimulus can prevent depression but risks inflation, as seen in 2021 to 2023. Resilience requires diversification. The crash showed markets can recover from the unimaginable if policymakers act boldly. The COVID crash wasn't just a market event. It was a test of humanity's adaptability and a reminder that the next shock is always around the corner. Thank you for listening to this episode.
This episode is brought to you by Workday. Guessing is for game shows, not your business, especially when your margin for error is zero. Workday is the enterprise AI platform for HR, finance, and IT, with a deep understanding of your organization's context and guardrails. So every AI action is permission aware, giving you accuracy 24/7 and the ability to not just get work done, but get it done right. It's a new Workday.
At Ollie, we've got wellness down to a science. From PMS to pregnancy to menopause, our women's wellness line offers science-backed support for every stage. No judgment, no shame, none of the stigma. Just supplements designed to meet you wherever you're at. Ollie, choose science over shame. Find support at a retailer near you or on ollie.com. That's OLLY.com.